What's up, everyone? It's Karthik with MoneyVest. So hope you guys are doing great, and thank you so much for all the best wishes. I truly am very, very grateful for each and every one of you guys. You have no idea. Every single person who watches the content, who supports the channel, who drops a like, subscribes, and is part of our MoneyVest community. You guys are awesome, and I love you, really, really do. And no, I'm not drunk. I joked around this in our Discord earlier today, but no. Thank you so much for everything that you guys do. I really appreciate you all. I will be doing a live stream later today, but this video will be scheduled to be released later. Wanted to go over the bond market and how it's gaining a lot of traction. And there are a certain couple calls that I want to go over from other institutional investors and banks as well. So hope you guys enjoy it. As always, make sure that you drop a like and subscribe to the channel. A special subscribe and of course drop a like for the birthday. I really appreciate you all again. And links to our Discord and Patreon is going to be down below if you want to join. Of course, be a part of our MoneyVest community and get access to all the Excel spreadsheets, intrinsic value spreadsheets, the members only private videos. Everything's going to be included with the link down below. And like I said, we'd love to have you on board. So let's get started. The U.S. bonds could be poised for big gains next year. Okay, this was from Chief Investment Officer Sarah Malik, and along with Guggenheim, they believe that bond market right now is indeed undervalued. There's a lot of opportunity in this sector, and they mentioned that yields in the $25.7 trillion U.S. Treasury market if it continues to slip. Her team estimated that the one-year Treasury bills could return about 5.2% in a year, even if there isn't any changes in the bond yields from current levels. But the potential for bond gains to shoot up 12.3% to 21.8% for the 10-year Treasuries. And we have been talking about the 10-year Treasuries for a very long time. And, many people do believe that yields have indeed topped and we are not going to see anything over 5% anymore. Of course, time will tell if that is indeed going to be the case. But this right here is the chart, which basically suggested that the 10-year Treasuries, if the yields do decrease by 100 basis points, in other words, 1%, if you see that decrease, 12.3% is the potential gain for the bond ETF, bond price ETF, and 30-year Treasuries could see as much as 21.8% gain for them as well. So the risk-reward trade-off, the marginal risk versus the marginal upside here is substantial, and there is an element of asymmetry here when it comes to the risk and reward. Now, Fed likely to cut rates below 3%, making bonds attractive right now is what Guggenheim also mentioned. So Guggenheim Investments thinks that investors should look past the carnage in bonds and gear up for a Federal Reserve to pivot to rate cuts. While the investment team expects the Fed to leave its policy rate unchanged at a 22-year high of 5.25% over the next several meetings, they also see a recession as likely in the first half of 2024. And that's one of the things that I've mentioned before, is that the only reason the Federal Reserve would cut interest rates is if there is a recession, right? They need an incentive to cut rates. Without a recession or without a deflationary risk, they will not move interest rates. And again, that's one of the main reasons, one of the main incentives why in the past the markets have sold off after the rate cut is because the rate cuts happened in the middle of a recession, right? So when the Federal Reserve cuts rates, they're most likely fighting that recession and the economy is not doing great. And as a result, stocks sell off. So I mentioned this in our Discord yesterday that if rate cuts happened with a recession, be prepared for the markets to go down. In other words, for us to see a little bit of that pullback and for us to see those opportunities. If rate cuts happen while there is no recession and there is a very good soft landing scenario where inflation is coming down, well, then we can expect the markets to basically, rally or rip higher on that quantitative easing assessment. This right here is from Fed's Neil Kashkari. There was a discussion speech earlier, and he said that there's no discussion about interest rate cuts. So he says, and I quote, that I have no idea where market participants are getting that. There's no discussion amongst me or any of my colleagues about when we're going to start preparing to cut rates. So once again, talking tough, being hawkish. That's exactly what Jerome Powell's been talking about as well. He said officials have discussed that when inflation is well on its way back down, if the Fed didn't cut rates then adjusted for inflation, monetary policy would be more and more of a drag on growth as well. That's real. That's math is what he also mentioned. So we know that the Federal Reserve is going to try to talk tough as much as possible to make sure the markets understand that rate cuts are not happening, even though if inflation continues to come down, if there is some softening in the labor market, we know that the Federal Reserve is going to potentially start looking into cutting rates as well. Now, this right here was another report which suggested that the debt to GDP numbers are becoming more and more concerning. And of course, the forecast is only to get this number higher and higher. In other words, it's only going to get worse when it comes to the debt to GDP ratio, nearly 100% and on track to rise further at almost 120% by 2032 as well. So the next 9 to 10 years, it's expected to get even worse as fiscal deficits are continue to expand as a percentage of GDP, and not to mention the overall federal debt as a percentage of GDP also expected to increase to well over 120% as well. So those right there are some of the estimates for the debt to GDP numbers, which obviously are not looking super great. That's a different report, but I wanted to go over some of these things and, of course, talk a little bit about the U.S. 10-year Treasuries, which in the past week has been selling off. Today, it's down another 90 basis points. So I do think that this is going to be a little bit of that transition week where I've mentioned in my previous market updates and reports that it is possible that we do see some liquidity kind of flood into the Treasury market, into the bond market, as a lot of funds, a lot of endowments funds, pension funds are looking to lock in some of these rates at 4.6, 4.7% for the next 5, 10, 20, 30 years. And that's going to create that influx in demand, which could lead prices higher, which is for TLT, pushing higher. It's been a little bit more volatile, but once again, it's up 1% pre-market, and it's going to push yields down because of that inverse correlation. So TMF also pushing up over 2.6% right now. So very, very nice move to the upside pre-market. So again, we're starting to see that yields roll over on the back of bonds on a risk-adjusted basis becoming more attractive. But again, I want to re-highlight one of the things that I've talked about before, is that a lot of the thesis is built around interest rate cuts. Okay, when you look at energy stocks, when you look at renewable energy, and I mean, when you look at electric vehicles, when you look at discretionary spend, when you look at biotech, when we look at small caps, when we look at the bond market, right? All these sectors that I just mentioned, all these areas of the market benefit greatly for when there are rate cuts. When there are rate cuts, this is the sector, including innovation and short squeezes and technology stocks, long duration stocks and bonds, as Kathy would also mention in her tweet, they benefit greatly when there are rate cuts, okay? And when would there be rate cuts? Rate cuts would only happen if there is a recession or deflationary risk. Now, if there is a deflationary risk, then that's actually, in the short term, a very good thing, because if prices are coming down to a point where they're now starting to turn negative, right, and the growth continues to be somewhat decent and unemployment is not high enough, then that's good, because the Federal Reserve can then cut rates and control inflation, bring it back above 2% or closer to 2%, bring it back up to, the Fed's target. And that's going to create a lot of economic sort of growth. It's going to stimulate quantitative easing once again. Now, if that happens, right, stocks are in a good position, in my opinion. But it's the latter which is the problem, right? That's more of a problem if interest rate cuts happen on the back of recession expectations when unemployment's also going higher. Because we've learned from our previous analysis and historical studies that every time the Federal Reserve does cut rates, they're doing that on the back of potential recession, which obviously leads to markets selling off. Every single time the Federal Reserve's cut rates. So if I bring you over to some of the other charts, so let's just go over to the Fed funds rate, or let's just type in S&P 500 here. And I'm going to plug in the Fed funds rate. So we're going to bring that over here. And again, if in the past, you'll notice that every time the Federal Reserve has embarked on this journey of cutting interest rates, the markets have sold off even further, right? So this right here, obviously they started cutting rates. They were, again, moderating a little bit here in 2020. They immediately dropped. That was a recession. You go back 2007, 2008, that was the same exact situation where you can see that as soon as the rate cuts began, we saw a significant collapse in the market. Same thing happened here in 2001, 1990s. You can see the rate cuts aligned with the markets selling off. And it's happened over and over and over again multiple times, as we can see over here as well. Federal Reserve cutting interest rates, markets selling off. So in other words, markets were anticipating a recession. They were doing a better job in anticipating a recession before. But now, obviously, what's happened is the markets have continued to somewhat stay strong, right? Even though we did see the bear market of 2022, and now we have moderated a little bit here. So if the Federal Reserve starts cutting interest rates, but there is a recession with that, markets are going to find it a little bit more challenging, at least in the short term. Of course, long term, and we're looking 12, 16, 18 months out, that's going to be very good because that creates quantitative easing. Earnings are potentially going to grow after the rates get cut. But in that environment, in that moment, in that trading window, there's possibility for the markets to obviously roll over. But if there's rate cuts on the back of a very strong economy, and soft landing, potentially inflation coming down, that is going to create a very nice momentum for the markets back over 45, 46, 4,700, possibly back up to all-time highs as well. So that's where we are with the entire market. Let me know your thoughts down in the comment section below, and what do you think about rate cuts and recession probabilities. As always, make sure that you drop a like, subscribe to the channel. Link to our Discord, Patreon is going to be down below. And as always, happy investing. I'll see you all in the next video.